Welcome back to MB Capital Strategies. Today we're continuing my Upstream series, specifically with number 5, Aker BP. One of the most efficient oil and gas producers in Europe. No downstream, no refineries, just pure upstream cash flow. The question isn't, is Aker BP good? But rather, is the current setup attractive despite the 2026 oil cycle? Who exactly is Aker BP? 100% upstream, focused on Norway, majority controlled by Aker ASA and formed from Aker, Det Norske and Lundin Energy. The result, one of the most cost-efficient E&P players in Europe. No international diversification, but maximum operational control. Let's also take a look at how I'm invested here. A total of 21 shares, bought at €20.03, currently up 20%, with a net dividend already received of €20.95. The 52-week high and low is between 18 and 25 euros. We're currently trading at €24.64. Analysts set a target of €22.70 here and Investing Pro at €31.01. Investing Pro has already created a Pro research report, which we'll take a look at in a moment. If you'd also like to use Investing Pro for your fundamental analysis, you can get a 15% discount through my link. You can find the link below in the pinned comment as well as in the description. Production for 2025. We had 420,000 barrels of oil equivalent per day. In Q4, we had 410,600 barrels of oil equivalent per day. So, the guidance has been fully met. Importantly, 2025 and 2026 is a downturn phase. It's not hype-driven growth. An average of 389,000 barrels of oil equivalent per day is expected for 2026. But from 2027 onwards, the picture will change. We have Yggdrasil, Valhall PVP, Fenris and Scarf satellites. 451,000 barrels of oil equivalent per day are expected from 2027 and 500,000 towards the end of the decade. That's a primed cash flow lever. And now for the game changer, the production costs. We have $7 per barrel of oil equivalent. In Q3 of 2025, we had $7.6 and the target remains around $7. Project break-even is mostly under $40 per barrel of oil equivalent. Portfolio break-evens here are between $30 and $40 per barrel of oil equivalent. And that means even at $60 oil, Aker BP remains highly profitable. Norway helps. Stable regulation, predictable taxes, and no political chaos. That is premium upstream. 2025 was the investment peak. CapEx, 2025 at around $6.5 to $7 billion. The result, free cash flow was weak or rather negative. We have an average free cash flow of about minus $1.8 billion. But the operating cash flow 2025 at around $6.9 billion, Q3 alone at $2 billion. From 2026-2027, CapEx will fall significantly. It is expected to be about $3.7 to $5 billion. Production is stabilizing, then it increases. Result, free cash flow explosion from 2027. The management estimate $9 to $13.5 billion cumulative free cash flow until 2028. And that is the real story. Net debt EBITDA at around 0.3 to 0.5. That is extremely low. Then we have net debt of about $5 billion deliberately ramped up because of CapEx. But we have no refinancing problems. We have secured a new $3 billion credit line and we have high liquidity. We have a stress test at $50 oil. The risk is price-driven and not structural. Now let's come to the dividend and why Aker BP is so popular at all. We have a quarterly dividend of $0.63. It results in a total dividend of $2.52 to $2.65. So the dividend yield is currently between 9 and 10%, depending on the price. Important, minimum growth of 5% per year as long as oil is above $40. But of course, this is not an aristocrat stock. This is a cyclical cash flow hammer. The valuation according to Pro Research would be a fair value of 325 Norwegian kroner. That would correspond to an upside potential of 30%. We have an EV/EBITDA of 2.2, which is extremely low. Then we have a forward price to earning 2026 between 10 and 11. So why the discount then? Oil surplus fear 2026, which is real, EPS revision short-term negative, and we have the cycle skepticism. That is timing risk, not quality risk. So what are the risks? Oil and gas prices fall more sharply. Here too, I see that oil might fall again to 30 to 50 US dollars, depending on how things develop with Iran. 2026 remains weak for oil. EPS pressure is short-term, 100% Norway exposure. But we have very low costs, we have a strong balance sheet, and we have no refinancing stress. The projects are running on schedule, and that is simply controlled risk. So what is my conclusion now? Aker BP is one of the cleanest cash flow machines in Europe. High dividends at about 9%. We have low costs, and we have a free cash flow boom starting in 2027. This is not a buy and forget or a set it and forget it portfolio, but perfect for dividend hunters, hard asset strategies, and cyclical cash flow portfolios. My current assessment is hold if you are already in. Buy on dips, ideal range at 30 to 50 US dollars for oil. That's it for the video on Aker BP. If you liked the video, I would be happy to receive a like here. Feel free to write what you think of Aker BP. If you are not a subscriber yet and don't want to miss future episodes, I would be happy if you subscribed here. Otherwise, as always, this is not investment advice, but just my personal strategy. I wish you all successful investing and see you in the next video.